Today is going to be a real short presentation on the differences of this new AHP fund. A lot of us did it. What was it, Dan? Like 2000 and what was the first one? 2015, right?
16. So the last one was 2015 A plus, and that was actually ran from 2016 to May of 2018.
Yeah, so I jumped in the first one a couple years back, and I've been using it ever since. And in case you guys are wondering, that's not George there. George went and hired a boss, and so she's sitting in there today. Good to see you, Dan.
Great to see you too.
And we're going to kind of talk to the differences since there was a lot of confusion, and some of the logos are different. AHP Servicing is what it's called now. Used to be called just AHP. And we'll kind of get going through this deck. I guess, yeah, maybe just kind of, let's just go through the differences here, and then I'll kind of chime in with questions that people have had.
Sure. So happy to do that. And Lane, do you want me to explain any of the changes to the name of the company, or does your audience have that background?
Yeah, why don't you kind of go over that just so people know where did George go? Did he disappear?
Right. He's not in witness protection program. He still is one of the principal shareholders of the company, and he's also the chairman of the board. So, Lane, as you mentioned earlier, he stepped out of the day-to-day operations. So in March of this year, he brought me in as the president and CEO of AHP and AHP Servicing. And that was really to kind of put the structure in place to scale the business and also to start the servicing company. So previously, we had serviced our loans with third parties, and George wasn't really happy with the job that any of them were doing. He tested out half a dozen different servicers. And so we reached the conclusion that we think we've got it figured out and we can do a better job ourselves. So in 2018, we set up the servicing company, went live on pilot with our own loans in August, and by the beginning of November had brought the majority of our loans in-house, and now we've started servicing for third-party investors as well.
Right.
And so that's the reason that the new offering is going out under AHP Servicing, because that's really, it's the sister company, but it's the company that will continue to build the organization and the platform under.
Right, because it's sort of become more of instead of just an investment company, but an operations company where, you've got the people in the office making the calls to the people, right?
That's right. And we feel like that's much better fit for our social mission, because we're genuinely trying to keep homeowners in their home after we buy the debt. And most of the servicers that we worked with, because they don't have that social responsibility, we just felt like they weren't giving the same level of time and attention to our borrowers that we think we can do for ourselves.
Yeah, because I think I was out there in March, and you guys had just about starting up the roles of all the computers and the call centers.
That's right.
What is the kind of the fundamental difference between like your average servicer? I forget what the names of the popular ones are out there, and you guys, like what specifically, is there something in the call scripts, or just what's the difference?
Yeah, so that's a really great question, and it runs the gamut. First of all, we're, I think, a much more tech-enabled company, so we have an out-of-the-box servicing platform, which everybody else does as well. But then we built this proprietary skin on top of it that's very interactive with our vendor partners and with our borrowers, as well as with our third-party servicing clients that we're starting to take on. So we think that that full utilization of technology is one of the differentiators for our company. And then you're right, everything from the initial outreach to our borrowers to, kind of making these decisions where we're doing the right thing for our investor, for the company, for the borrower, for the servicing client. It means that you're not always kind of squeezing that last dollar out of a modification or a discounted payoff, but you're getting a quick consensual resolution. So one of the things we did this summer is we took a look at, for 2015 A+, which is the most recent fund before this one, what were the borrower outcomes? And so in about 30% of the cases, we're having to file a foreclosure action versus having some kind of a consensual resolution to the loan that we purchase. And, the typical bank or the typical investor, that foreclosure rate may be, there are no stats because I've looked at them, but it would be maybe 80 or 90%, right? So where the majority of the time, somebody else is just going to move to foreclosure when a loan is 90 days past due. We're actively working to find that solution and making foreclosure our last resort. And we really think that's better for everybody. We get quick, fast solutions. It's better for the borrower. They can settle their debt or modify it. And it's better for the community as well, because you don't have a vacant home kind of sitting there becoming dilapidated in this neighborhood, because nobody wants to, own a home where the home next door is unkempt and abandoned.
And for those actual note investors out there that operate in their own facet, getting a few notes here and there, they can actually engage with you guys to do the servicing for them, right?
Correct. And, I think one of the areas that we're really set apart as a servicer is because we're also investors. We know what they're looking for, right? They're making that investment and they're looking to get that return on the investment so that they can then use the proceeds to either get cash flow from that asset or to turn it around and invest in a new asset. So having a servicing partner that you can buy loans from, sell loans to, who understands your mindset, I think is going to be really powerful over time.
All right. So let's get into this, the actual fund, which is really what we're kind of talking about here today.
Yep.
So on the left, we've got the old fund and then the new one. Maybe we'll kind of just go line by line just to kind of just point out the differences here.
Yeah, absolutely. So this first page that we've got up is actually the similarities. And so they're both SEC qualified Reg A offerings, so crowdfunded. When somebody makes an investment in the offering, they get an equity investment. We continue to allow them to invest with as little as $100. It's still open to both accredited and non-accredited investors. And those two elements are really foundational for our belief that we should be making attractive alternative assets available to everybody in the marketplace. Our distributions are still paid on a monthly basis, and we still have best efforts liquidity, competitive returns. If you want to flip to the next slide so that your listeners
no differences on this page, guys.
No differences. Yep, everything's the same. Offering size is again 50 million, and so with 2015 A plus, we actually raised about 35.5 million. So far, since we opened this new offering with AHPS, we've been raising about $1 million a week, so off to a really great start. So if that run rate continues, we think we'll hit that full 50 million late 2019 to early 2020. So we do expect this one will be fully subscribed. We do continue to have a best efforts liquidity with no lockup period. So if something changes, we will use best efforts to redeem your shares.
So I think that's the one of the biggest appeals that personally I like this the fund. You got other funds out there where they'll lock your money up for at least a couple of years, but there's that big quote right there, right? This best efforts, and maybe we can kind of talk about that a little bit. I mean, is it more as money comes in, you're able to let people out? I mean, but the intention is that not people don't just use this as a 3-month float account, right?
Yeah, so you're exactly right. And we'll talk on one of the next slides. We talk a little bit more about some of the nuances that have changed, but I love the best efforts piece as well. I think it's great for investors, especially because I think at this point in the market cycle and the overall U.S. economy, we're predicting, I should say the pundits are predicting a recession in 2020, right? So, while we hope people put it in and they can keep it there forever, we understand that circumstances change. So the way we handle the best efforts is, we always keep some cash on hand, right? So we're not going to be 100% invested so that we can make sure we have money available for operating expenses, for monthly distributions, and we forecast, the likely redemptions in any given month. So we kind of look at what the historical numbers are, how does that change as the fund ages, and we try to keep sufficient cash on hand to meet most of those. Now, occasionally we'll get somebody who will be a very big investor, and in that situation, we may need to redeem that over longer than a 30-day period, and we'll work with them based on what their needs in their particular situation is. But in general, we try to redeem within about 30 days of the request.
Yeah, and just to give you an idea, what I'm kind of telling my guys is I'm using this as sort of an opportunity fund. I put money in here, but I sort of draw money on my life insurance, my infinite banking first, and this is kind of that second stopgap in case, you know, really good deal comes up after another good deal, and kind of draws me out that way. But yeah, I mean, I haven't taken money out. I took money out once, I think late last year. You guys did it in like 2 or 3 weeks for me. And then I replenished the money before the 2015 A closed. And I'm really trying not to touch the money.
Yeah, you know what? And I think that's smart because when you look at the return, right, that 10% return, and you compare that to what the stock market is doing in the bond market and what you get in a money market fund, I research every crowdfunded company that I come across because I'm always interested in what are our competitors doing and what are they paying. And it's very hard to find any alternative crowd-funded company that pays that double-digit return and pays it consistently and still has some liquidity.
Right. I mean, I remember when I first met George a couple of years ago, I told him that 12% was a little bit too high, and it kind of sounds like a scam because it is so high.
I
Um,
told him the same thing when I was interviewing for the CEO job because it created this impression that it was a higher risk investment than it actually was.
right, right. I
Yeah,
mean, I think even at 10%, I mean, for the liquidity, I mean, you can't beat it, in my opinion.
thank you. I agree. So other things in terms of similarities and differences, the term length is still 5 years. And what that means is, you know, so Lane, if you make an investment or when you make an investment, we're trying to return your individual principal within 5 years of you making that investment. And so I make that distinction because some people think it's within 5 years of launching the fund. Other people think it's within 5 years of closing the fund, but it's within 5 years of the individual investor making that investment.
So if you're in the original fund, you're going to get your money back in 5 years, and the fund will likely close. Is that kind of what's happening?
Yeah, typically the fund will liquidate over time. And so, you know, sort of 3 to 4 years after the launch of the initial fund, we'll make sure that we're planning and taking advantage of market opportunities to sell loans at a premium and, you know, then kind of waterfall the return of the investor principal.
But, you know, likely investors will roll right into the current fund. But what about the assets in the old fund? Will the new fund buy those assets? Will there be a little of that going on?
So they can, and historically, George did some of that. So successive funds would buy trailing assets in some of the older funds. And that'll just depend on market conditions, right? Because we want to make sure that if we're buying them, we're buying them at a fair market value. So we'll evaluate whether it makes the most sense based on what's going on in the market and the liquidity of the future funds to either sell them in the open market or sell them to the sister offering.
Makes sense. Makes sense. Still, the social responsible focus and the correlated returns to the stock market.
Yeah,
I
so
think that's the big thing with you guys is the non-performing notes, right? Like it, in theory, it does well in a bad market.
that's exactly right. And that's one of the things that I really like is that our returns are not correlated to the stock market and they're really not correlated to the economy either because you know, when you think about what happens in a recession, foreclosure rates increase, banks are trying to move those loans and get them off their balance sheet so that it makes their balance sheet look healthier. And so that creates more buying opportunity for us and more opportunity to work with homeowners and potentially more opportunities to do additional offerings if there's a lot coming onto the market at one time. So we're not afraid of a recessionary environment. So next slide here in terms of other key differences. You mentioned this earlier, Lane. So the last offering was issued by American Homeowner Preservation, and this offering is issued by AHP Servicing, which now includes all of our employees. We manage our own servicing, and we manage the portfolio for both 2015 A Plus and for AHPS, as well as handling some portfolios for third parties. Other difference, the last one paid a preferred 10% return. This one pays a preferred 10% return, which I feel is still top of the market in terms of what our competitors are offering. But to your point earlier, I think it's more appropriate to the maturity of the company because the reality is AHP celebrated its 10-year anniversary in May. So it's very much a proven product now versus kind of a proof of concept with some of the earlier offerings. And then I would like to talk a little bit about the changes to the best efforts liquidity. So, to encourage folks not to treat it like a money market fund, we do adjust the returns if somebody redeems in the first 2 years. So if you redeem in the first year, we'll adjust that annual return from 10% to 8%. And if you redeem in the second year, we'll adjust from 10% to 9%. And if you keep it in the fund for 2 or more years, then you get that full 10% return.
Right. I mean, here's what I say. Like, if you're worried about like losing a point or two because you weren't able to manage your liquidity, that's your own fault. And you really shouldn't be using this as a put in here for 6 months and then go to something else.
Yeah,
That's just
I think
my
that's right.
input. Yeah, the first one was 6 months. It would go down a point, and then another 6 points, or 6 months, you would get back another point. This one's sort of similar, maybe dips on the 8, but if you're sweating over 2%, you need to get a life, I think.
Yeah, well, also when you look at some of the other alternatives that would have the liquidity, right? Most of those are returning 5 to 8%. So we're still, even if somebody has to redeem within the first year, we're still offering a better return that they might get in some of the alternatives, like some of the peer-to-peer lending platforms. Other thing that I talk about in terms of a difference in liquidity is that we do have the ability to limit redemptions to not more than 25% of the fund in a given year and not more than 25% of the investor's total shares. And for that second one, the only time I think that may come into play is when we get a very large redemption request. So, we get people who invest $500,000, and we just want them to be aware that, depending on how fully invested we are, that may not be a 30-day redemption.
Yeah, and that's nice that you actually mentioned that. I mean, everything kind of changes here and there, right? You guys reserve the right, but would you say, like, if a guy's just putting in $50,000 to $100,000, they kind of fly under the radar?
I think that's right.
Okay. And for the guys who have never even heard about AHP, or kind of been living under the rock for the last couple of years and just totally disregarding all the podcasts ads out there that I've been doing talking about this thing, because it still happens. I have calls with people. People are like, "What's an AHP?" I'm like, "Really?" Like, so this is a little bit different than like a mutual fund or your run of the mill like fund out there that's put on by Fidelity or Vanguard. I think when I first started to invest in this thing, it was a little bit off the beaten path, right? It's still regulated, and how are investors out there, how would they go about doing their due diligence on their side? How do they know that this is just not some random fund that doesn't really exist, that you're just doing a big Ponzi scheme on?
Yeah, that's a great question. I'm glad that you asked that. So we have a lot of information available online. One of the reasons that we are an SEC qualified Reg A offering is so that our investors can be comfortable that we've gone through a robust process. The offering has been reviewed by the SEC. Our offering a statement is available directly through Edgar. It's also available on our website. If you go to our new website at ahpservicing.com, you'll find all sorts of information about the new offering. And if you go to our old website at ahpfund.com, you'll be able to see all of the documents related to that offering. And so there's a long history of 10 years here. So we also show both in our offering statement and online how all of the prior funds have performed. One of the other things that we do that I wish more of our competitors did is we produce audited financial statements on the company every year. And, frankly, when I was interviewing with George, if he had not produced audited statements, I would not have accepted the job, because coming in as the CEO, I want to be comfortable that I'm coming in with a clean set of books. And to your point, I want to be comfortable that it's not a Ponzi scheme, right? I would not look good in orange. And so I think that's something that sets us apart. It creates a lot of visibility. One of the other things that sets us apart is you can always talk to a live human being. We have a great investor relations team. They're very knowledgeable. They're super hardworking. And, as I continue to find out, new competitors out there, I'll always check and see, do they produce audited numbers and can I talk to a live person? And more often than not, the answer is no. And so that tells me that that's a company that's maybe not as mature in its life cycle. So therefore higher risk as an investor.
All right. And I've been in this thing for the last almost a couple of years and been getting, I always say that it kind of pays my car payment, but I don't have a car anymore. Gave that up. I just ride a bike around.
Good for you.
And if you guys want to go to SimplePassiveCashflow.com/AHP, there's probably about a couple hours of webinars and videos on there that me and George did in the last couple of years, talking about what exactly are they doing in the note funding or note fund investing. So you can actually know what you're investing in. And I think Deanne also mentioned EDGAR, which is on the SEC.gov website. And those government websites, a lot of information, very hard to use and sort of impractical. But you can use that tool if you're ever so inclined to go and like pull up every single PPM out there for every single deal in the world. If you're good with computers and you can program stuff, you can make a little query to pull what you need. But it's all right there, and then you can kind of pull up the financials yourself.
Exactly. So you can get it through our website, or you can go get it online direct from the SEC.
Anything else, Dan? I think what's up with George? He's still in the same office doing his other new business.
Yeah, so he is. So he kept the old office. We moved to some new offices on my first day on the job. And he has started a new company to keep him out of trouble. He's the classic entrepreneur. So his new company is expected to launch in January, and that's called Debt Cleanse. And his aim there is to help individual investors who are burdened by debt figure out how to get back on track. So kind of an interesting evolution, right? AHP Servicing started to help, borrowers and homeowners get out of debt. And so he's now taking what he's learned over the last 10 or 15 years to a wider audience and partnering with a team of attorneys that he's putting in place to help make that possible for folks.
All right. So if you guys want more information, go to my website, check out those webinars. But if you're ready to invest today, go to ahpservicing.com. And thanks for joining us.
Thank you, Lane. Appreciate it.